Most people prepare for a recession. Almost nobody prepares for the kind of crash that changes what money itself can buy. A lot of people think a crash means stocks fall 30%, you hold on, and everything eventually recovers. That is a recession or a bad quarter. A real crash rewrites the rules of money overnight. Argentina in 2001, Greece in 2010, Lebanon in 2019, and Weimar Germany in 1923 all showed the same pattern. Your bank account can still display the same number, but that number can no longer buy even something basic. Traditional advice about diversifying and waiting out the storm is built for normal downturns. In a genuine collapse, some assets do not just lose value, they become toxic, and at least two of them are probably already sitting in most portfolios. First are luxury consumer goods, high-end watches, a $90,000 SUV, a boat, designer pieces, or collectible sneakers sitting in a climate-controlled closet. These things feel like wealth because they signal status, but their value depends on two fragile conditions: disposable income and the desire to display status. In a real crisis, both disappear. When people are genuinely afraid, they do not buy a Rolex. They buy rice. In Buenos Aires, after Argentina defaulted on $93 billion of debt in December 2001, the peso broke, banks froze, citizens could not access savings, and unemployment hit 25%. Before the crash, a 3-year-old BMW 5 Series might still hold about 60% of its original value. Within 6 months, the same car was selling for 15 to 20 cents on the dollar, if it sold at all. You could not sell it for pesos because nobody wanted pesos, and you could not sell it for dollars because nobody had dollars. It just sat there losing value while still costing insurance and taxes, while the neighbor with a bakery was trading bread for medical care. The same pattern showed up in 2008. Luxury spending fell 15 to 35% across markets. Resale prices for high-end watches fell 40 to 60% within 18 months. Luxury vehicles depreciated far faster than normal, and boats became nearly unsellable. During Weimar hyperinflation, families sold grand pianos, fur coats, and antique furniture for a week of food. Luxury goods are consumption disguised as investment, and in a real crash, the disguise comes off. Second are long-term government bonds in the local currency. This is the asset retirement funds and conservative portfolios, often overweight, and the one advisors love to call risk-free. But a government bond is simply a loan to a state. You hand over money today, and the state promises to pay you back later in its own currency. If that currency is devalued, inflated away, or the debt is restructured, your safe bond becomes a receipt for purchasing power that no longer exists. Greece made that visible in 2012 when private bondholders, including pension funds, retirees, and small investors, took a 53.5% haircut almost overnight. More often, the default is quieter. After World War II, U.S. debt reached 119% of GDP. The government did not openly default. It kept interest rates below inflation for years. If you bought a 10-year treasury in 1945, yielding 2.5%, while inflation averaged 6%, you lost 3.5% of purchasing power every year. After a decade, your supposedly safe bond had lost roughly a third of its real value. The state paid every nominal dollar it owed. Those dollars just bought far less. That is financial repression, and it is the standard playbook of over-indebted governments. Argentina in 2001 destroyed $82 billion of bondholder wealth. Russia in 1998 wiped out its domestic bond market in a week. Venezuela made its bonds effectively worthless as the Bolivar disintegrated. Governments faced with unpayable debts only have three real options: default explicitly, restructure, or inflate away the burden. All three destroy the bondholder. Long-term bonds are especially dangerous because they lock you into fixed payments just as the currency loses value. What gets marketed as risk-free is often risk-free only for the issuer. Third is cash and cash-like savings. In a normal economy, cash is useful, gives you liquidity and options. But in a true monetary crisis, cash does not just underperform, it evaporates. Cash is only a claim on future purchasing power denominated in a state-controlled unit. If the unit collapses, the claim becomes meaningless. Lebanon showed this brutally. After October 2019, the Lebanese pound had been pegged at 1,507 to the dollar since 1997, and people trusted that stability. They kept their savings in pounds and deposited lifetime earnings in Lebanese banks. Then the peg broke. The black market rate reached 15,000 per dollar by 2021 and more than 89,000 by 2023. A family with 150 million pounds in savings, once worth roughly $100,000 at the old rate, was left with only around $1,600 of real value. The same number sat in the account, but 98.3% of the purchasing power was gone. Weimar Germany worked the same way. Workers were paid twice a day because a morning wage could be worthless by evening, and people ran from factories to stores just to convert paper into anything tangible before prices changed again. In Venezuela in 2018, the Bolivar lost 99.9% of its value. Even in the United States, without hyperinflation, cash savers were quietly drained when real rates turned negative. Someone who left $100,000 in a savings account from 2008 to 2015 earned almost nothing, while inflation kept eating away at value, losing about $15,000 of purchasing power, even though the statement barely changed. Cash is not wealth. It is a temporary representation of wealth in a unit the state can sacrifice. Fourth are speculative growth stocks. Not all stocks belong in this category. Companies with real revenue, real cash flow, real exports, and real assets can survive a crash, and sometimes even come out stronger. The ones that get destroyed are the companies with no profits, no dividends, no meaningful tangible assets, and business models that depend entirely on cheap capital and optimistic forecasts. Those stocks do not just fall in a crash, they can go to zero. During the 2008 financial crisis, more than 400 publicly traded U.S. companies went bankrupt. Washington Mutual collapsed in the largest bank failure in U.S. history. Lehman Brothers vanished with $699 billion in assets. General Motors needed a government rescue to avoid total liquidation, and shareholders were wiped out. In Argentina in 2001, the Buenos Aires stock market lost more than 60% of its value in dollar terms within months. In Greece, the stock market fell 92% from its 2007 peak to its 2012 bottom. An investor with 100,000 euros in Greek stocks was left with 8,000 euros in the surviving names, and dozens of companies disappeared from the market entirely. The mechanism is simple. Speculative stocks are priced on future earnings that do not exist yet. In a crash, discount rates rise, the present value of those hoped-for earnings collapses, and the supply of cheap financing disappears. Cash-burning companies die first. Fifth is leveraged real estate, not real estate itself. Productive, unencumbered property in a stable legal system can be an excellent store of value. The danger is property bought with heavy debt into a market that later breaks. Now, when you buy a house with a mortgage, you do not really own the house outright. The bank owns most of it, and you own the equity. In a crash, prices fall while the debt stays the same. Your equity shrinks, and once the value of the property drops below what you owe, the asset turns negative. You owe more than the property's worth. That is exactly what happened in the United States from 2008 to 2012. Home prices fell about 33% nationwide, and in places like Las Vegas, Phoenix, and parts of Florida, the drop exceeded 60%. More than 10 million Americans were underwater on their mortgages, and about 3.8 million foreclosure actions were started between 2007 and 2010. The damage was not just the loss of the house, it was the trap. Owners could not sell without bringing cash to closing, cash they did not have. They could not refinance because the collateral was worth less than the loan. They were stuck making payments on a falling asset while their income was often shrinking at the same time. In Greece, property values fell 45% between 2008 and 2017, and the government raised property taxes as revenues collapsed, pressuring owners who were already losing money. In Spain, prices fell 37% between 2007 and 2013. More than 500,000 families lost their homes, and losing the home did not erase the debt. People were left both homeless and still indebted. Leverage magnifies gains on the way up and magnifies destruction on the way down. A 20% decline on a property bought with 10% equity is not a 20% loss. It is a 200% loss of equity. By contrast, productive debt-free land has historically held up far better through economic collapses than debt-loaded housing or commercial property. These are the 5 assets that get destroyed in a real crash: luxury consumer goods, long-term government bonds in local currency, cash and cash-like savings, speculative growth stocks without profits, and leveraged real estate. They all feel safe or prestigious in good times. That is the trap. Safety is not an inherent quality of an asset. It is a function of the environment. A life jacket is safety equipment on a boat. In the desert, it is just dead weight. And this matters because the environment no longer looks normal. Global debt has surpassed $315 trillion. The United States alone carries more than $38 trillion, and the interest bill now exceeds military spending. The warning signs that preceded crises in Argentina, Greece, and Lebanon tend to appear in economies people assume are untouchable. The real question is not which asset looks safest during a boom. It is which assets still hold value when the rules of money change.
Thanks for watching. If you enjoyed this video, please leave a like, subscribe to the channel, and share your thoughts in the comments. Stay informed, stay rational. See you in the next one.